It's all very well and good making all this money in property, but what's the point if we're not keeping it? Today we're going to be breaking down tax, and more tax. Before I jump into this, it's worth saying I am not an accountant and not a financial advisor, so please don't take any of this seriously. It is just one man's opinion. First of all, let's jump into stamp duty. Stamp duty, or SDLT, is a very annoying tax, if I'm completely honest. It's a tax on the land that you end up purchasing, which is incredibly annoying because you pay it when you buy something, you pay tax when you sell something, you then use the money to buy something else and pay even more tax on that. So how exactly does it work? Well, if you're in the bracket of 0 to 39,999, you're in luck, you're paying absolutely nothing. But let's face it, you're probably not in an area in this. And by the way, this is all for investment purposes. So if you're investing in a buy-to-let, it counts as an additional property. So you're not actually going to pay anything at all. The next bracket though, what if you purchase something between 39,999, can't be bothered to write it out again, and 125,000? Well, you're going to have to pay 3% in stamp duty. Fairly manageable. By the way, if you're in Wales, sorry about this, 4% for you, lucky lads. On the other side, then you've got 125,000 and all the way up to 250,000, which isn't really a big bracket, and that's going to jump you up to 5%. And if you think that's bad enough, everything between the 250k and 925k is going to set you back 8%. Now, that is an absolutely huge jump, but it's not quite as bad as you think, but still quite painful. And so what happens is it very much works like income tax in the fact that they are bands. So it's not 3% of everything there, 5% of everything there, 8% of everything there, apart from the first jump. So this is 3% of everything above 40,000, but everything else is a bit different. For example, if you've got £150,000 as a property purchase price, then the effective rate is 3% of everything up to 125,000, and then 125 to 150 is at the 5%. And it's called an effective rate of stamp duty, which on that one would equal 3.333333%. Stamp duty, bit of a bugger, but if you talk to a good accountant, there are a lot of strategies to mitigate or entirely eradicate stamp duty. Not for this YouTube channel. Next is income tax. I'm not going to lie, income tax is not great for anyone, right? It's the only thing we can guarantee is tax and death, but tax on the income is an absolute ball ache, isn't it? It is a part of life, but I'm not a big fan of it. The fact that I go out there, work my arse off as we all do to earn some money, and the government says,
"Well done. I'll take some of that, please."
But it is mitigatable. That's a word. It dependent on how you want to do it. So let's run through it and let's go through personal. Let's say you own a property in your personal name. So this is you with one leg apparently owning this property. Well, income tax is actually, it would have been great a few years ago, apart from the dreaded Section 24 came into play. What this means is that you get a 20% allowance that stops you paying tax on that, but all of the mortgage interest doesn't count, as a legitimate expense, which is absolutely crazy in my opinion. And so this doesn't impact you that much if you're in the lower tax bracket, 20%, but if you're at 40%, it actually has quite an impact. Let's give an example of this. Let's say it's a £15,000 per annum rent roll. You're going to get taxed 20% off of the top of that. Let's say that is net of direct costs like management and things like that, by the way. What's left over before paying your interest is your 15,000. So let's say at 20%, that is £3,000 in tax. And let's say 5k of that is of your actual mortgage interest. Well, you're going to get 20% relief on that. So you're going to be able to take off 20% of 5,000, which is £1,000. And then that's going to create a relief, which means at 20%, you're going to pay a £2,000 income tax bracket, which isn't the end of the world, but still a little bit painful. Well, what about 40% taxpayers? This is where it does impact. So at 40%, you've got 40% of the 15,000, which is £6,000. Let me put a line there to divide it a little bit. You're still going to only get the 20% relief, which is the £1,000. And so on this particular property, you will end up paying £5,000 in tax. That is obviously a huge difference in tax that you're going to pay. But what about in a limited company? So let's assume very roughly that we're at about 50% of profit. So 50% of 15,000, profit is 7,500. So in the example of 20%, we're going to get 5,500, which is 7,500 minus the 2,000. So 5,500. And then in the 40% example, we're going to get 7,500 minus the 5,000 in tax, which is only £2,500 profit. Let's see how that compares to a limited company. With a limited company, again, we're going to assume £7,500 profit. In a limited company, we currently pay tax on all of the profit, doesn't matter anywhere, at 19%. What this means is we're going to times 7,500 times 0.81, which is 81%, and that gives us £6,075. So immediately, that is more profit than both of those two situations. So if we're going to keep it in the company, it's almost definitely best in a limited company. But talk to your tax advisor. I am not a qualified tax specialist. But what if you actually want to use the money? Because that's a very different thing. The reason that's important is you then have something called dividend tax. As if the government hasn't taxed you already on your profits, if you now want to spend the money before you pay tax on anything you buy, you now need to pay a tax for the right to spend your own money. Seriously. There is a couple of grand allowance when you can take £2,000 per annum tax-free, thanks G-Dog. But after that, everything is 8.75%. If you are a lower income taxpayer, it actually goes up to 38%, which is absolutely insane if you're a higher taxpayer, right? So at 8.75%, what we now need to do is times this number, 6,075, by 91.25%, which is going to give you the figure minus your dividend tax, which is 5,543.44. So again, if we compare these two figures here, it's definitely better if you're in that higher tax bracket, but again, you actually have to factor in 40%, which would end up taking more, 38%, sorry, which then would end up taking more, but still better off. But if you are a lower income tax earner, then it's probably best keeping it out based so far. The difference here is, number one, are you going to be utilizing the money as an individual or not? If not, personal opinion, almost definitely a limited company, but talk to your tax accountant. If you are going to enjoy that money on an ongoing basis in the short term, it's probably dependent on, number one, if you're a higher income tax payer, and how many properties you're actually looking to get. If you're a lower income tax earner and you're looking to get 1 or 2 properties, it might be better for you to keep it in your personal name. Whereas if you're looking to actively build your portfolio over the years, my gut is for most of you watching is probably better putting it in a limited company. Even when you run these figures at the higher dividend tax, which I've been saying 38, I think it's actually 37.5, that will need to be factored in and still be better. But there are some more considerations. Number one consideration is that in 2023, corporation tax is going up. And because why not? Just why not? So currently we are at 19% and it's going all the way up to 25% corporation tax. Yay! don't fret too much. It's 19% for everything up to £50,000. And then it tapers up as you're going through. And if you're over £250,000 profit, you're going to end up paying 25% on corporation tax. Worth saying to you, by the way, that you might think you're being smart dividing all the companies up and having different limited companies. Believe it or not, HMRC have thought about this, and it's all connected companies. If it adds up to over £250,000 in any of your businesses, it will add up to 25%. The other two considerations is the costs on running a business, and these can include accountancy fees, your completion statements on a yearly business. They're fairly minimal, by the way, but it is something to think about. So I'll just put corporation there, so corp. But also you've got the fact that there are slightly increased percentages on interest. So when you are borrowing money, you are likely to pay a higher percentage on lending to a company rather than an individual. It's only about 0.75% difference, but that can make a big difference in the long-term profit of your business. So income tax needs to be down to you. For me, it's a limited company all the way moving forward. I'm currently looking into different structures. I'll feed back here. But for some of you, it might be as an individual. Outside of that, we've got capital gains. Good old CGT, capital gains tax, because once you've made all this money and you think, do you know what, I've worked bloody hard, I'm going to sell off my assets, let somebody else monetize, and I'm going to retire on the proceeds. Oh, not before good old Sam gets his hands on it. You are going to be taxed at between, or not between either, 18% or 28% on any increase in profits. Insane, right? But seriously, if you sell, anything you make on a profit is going to be taxed even more. The only thing you've got going for you is there's around £12,300 allowance per year. So that means the first £12,300 you make as profit by selling is tax-free. And the way that they base this is if you are a 20% income taxpayer, you're going to pay 18%. And if you're a higher income taxpayer, 40% or higher, then you're going to pay 28% because, hey, tax the rich as much as possible, right? So that's how it works with capital gains. There are ways to mitigate capital gains. For example, if you add value to a property, like putting on an extension, that is a capital allowance. And so that will come off of your taxable bill and some other bits as well. But ultimately, you're getting taxed on the way out. This isn't true if it's your personal residence, by the way. So if you're renting a property and you're doing flips, buying, refurbishing and selling, my recommendation is maybe move into one of those whilst you're doing the refurbishment, and then you can pay zero tax on any of the profits. You thought we were done. Oh no. What about when you die? Well, you don't care, right? Well, you might do if you're handing it to your kids, because they are going to get hit with another 40% on death tax or inheritance tax. And this is really where the individual, not so happy now, versus the corporate structure, limited or LLP, suddenly gets a bit better through mitigation. Now, there is an allowance which currently is $325,000, where you won't pay any inheritance tax, but anything above above that amount will get taxed at 40%. Thanks, Sam. But everything over here is taxed a little bit differently, because you can do transfer of ownership relatively easily whilst mitigating any stamp duty costs of the transfer of ownership and a lot of other stuff. The other thing that you can do, by the way, is you can package this and you can put it in a trust relatively inexpensively, and then you can have a will where your offspring has control of that will, and so will get all of the assets and control of the assets tax free. So there's absolutely no tax to do, but talk to an accountant and an advisor on how to structure that. On the individual side, the only way that is really there to mitigate is honestly only on your personal residence. So if you've got a high value home with a lot of money that's going to be handed down, what you can do is gift it to somebody. And you might have heard of the 7-year rule, and it's the only effective way that I know as an individual, without incorporating it, putting trusts and stuff, to mitigate it, where it goes and it tapers from 0 years to 7 years. 7 years completely tax free with some I's dotted, T's crossed, all of that sort of thing, all the way up to 40% if you gift it to them today. So if you are going down that route, I recommend moving quickly because anything can happen over the 7 years. Or ultimately, my opinion, not advice, is the company structure is just so much more protective of any estate planning taxes that need to be taken account of. We all hate taxes, right? Well, no, actually, I don't mind taxes. And actually, if you want to be a great businessman or businesswoman, start to love taxes. The reason for this is making another pound in business is harder and harder the bigger you get. And when you make another pound at my level, I'm probably only making about 35 to 40 pence per pound. That's a lot of money more I need to make in order to keep that little. On the other side, if you learn how to save a pound, you keep a pound. And by the way, this is true if you're a multi-million pound business owner, you've got your property portfolio, or indeed you're earning 20 to 25 grand a year. I guarantee there are tax saving circumstances that you can be thinking of, even as an employee, that you can take advantage of. But hey, that's just my opinion. Make sure you're talking to a tax advisor who's actually qualified on this stuff. If you got value from this video, make sure to hit the subscribe and the notification bell, and I'll see you in the next video.